If investing feels confusing, it's not your fault. The financial industry is built to keep it exactly that way. Brokers, banks, and advisors often push strategies that sound very impressive, but are entirely designed to benefit them, not you. But there are actually decades of independent peer-reviewed research, some of which has been Nobel Prize winning, that show exactly what works. These are clear, simple principles that give you a better chance of long-term success. Over the past 20 years of working with successful international families, I've seen the damage that the industry-first approach can cause, and how powerful it can be when you start investing with science and evidence on your side. So in this video today, I'm going to show you the 10 core principles backed by real academic research and one perspective at the end that could completely shift the way that you always think about investing for the rest of your life. Let's start with a scientific framework for investing. Over my lifetime, science and technology have produced many tremendous advances, from life-saving medical treatments to instant communication. Historically, though, science has had very little influence on investing. Despite advancements in modern portfolio theory and historical evidence, investors and money managers often rely on very outdated methods. These include traditional outdated wisdom, human emotion, promoted by those with deeply vested interests. After all, as Upton Sinclair once quoted, it's very difficult to get someone to understand something when their salary is dependent upon them not understanding it. By this, I mean that if someone is paid to sell the same old snake oil by a brokerage, a bank, or an insurance company, then that is exactly what they're likely to do. It's just a vested interest and an inbuilt conflict in the system. In contrast, the evidence-based or systematic investment movement championed by fee-based fiduciaries and investment stewards, i.e. those who have a legal duty to act in the interests of those they serve, i.e. you, the clients, exposes many of the shortcomings of this conventional approach and provides a tested road map to successful investing. The objective of successful investing is really to maximize your net returns and optimize your expected outcomes, all whilst minimizing the risk and protecting your capital from downturns. So, fundamentally, investing is the process of building and preserving your future purchasing power in order to fund the lifestyle and personal choices you want. Improving your statistical odds in your favor by following some key principles will create a much higher probability of success over the long run. These 10 principles next will help you avoid the dangers of market timing, stock picking, higher costs, and making ad hoc investment decisions. They'll also help you take advantage of opportunities provided by efficient capital markets and provide a systematic, time-proven way to reach your financial goals. So, what are the key principles to improve your chances of success? The stock market is an effective information processing machine. Every day, the world equity markets process billions of pounds in trades between buyers and sellers, and the real-time information they bring helps set prices. They start with all of the available information, and then you have approximately $650 billion of daily trades, each one setting a fair market price. It therefore makes very good sense to accept that these market participants, on average, get these prices right and that the overall market is broadly efficient. This means that you're always buying into it at a fair price based upon all the huge amount of information available. To learn more about this, just simply Google efficient market hypothesis and the Nobel laureate Eugene Fama. The stock market's pricing power works against traditional active fund managers who try to outperform it through stock picking or market timing. As evidence to support this, only 18% of 2,860 US domiciled equity funds and 15% of 1,655 fixed income funds have survived and outperformed their benchmarks over the last 20 years. The traditional expensive active fund industry hate this, but the data indicate these tiny numbers may just be attributable to luck. Luck isn't a place to start prudent financial life planning or building a reliable or certain future. Some investors select investments based upon their recent past returns, yet past performance offers very little insight into a fund's future expected return. For example, most funds in the top quartile of the previous 5-year returns didn't maintain top quartile rankings in the following 5 years. More specifically, only 22% of equity funds and 31% of fixed income or bond funds that were in the top 25% between 2015 and 2018 stayed in the top 25% between 2018 and 2023. The financial markets have always handsomely rewarded long-term investors. People expect a positive return on the capital that they supply, and historically, the equity and bond markets have provided growth of wealth that has more than offset inflation over the long term. However, the long term really does mean the long term, and success is measured over many years, not over quarters. There is a wealth of academic research into exactly what drives return. Expected returns depend upon current market prices and expected future cash flow. Investors can use this proven information to pursue higher expected returns in their portfolios. For example, in regard to buying into the great companies of the world on the stock market, there are 3 expected premiums to potentially consider. The first of these premiums is company size. Now, smaller company stocks typically outperform larger stocks over periods of time. The second premium is relative price. Value stocks typically outperform growth stocks or those with a relatively higher price over time. And the third of these expected premiums is profitability. Higher profitability company stocks outperform lower profitability companies over time. Now, in regard to owning fixed income or bonds, there are also 3 drivers. The first of these is term. Wider term spreads generally lead to higher expected returns for longer duration bonds. The second is credit, because wider credit spreads generally lead to higher expected returns for lower rated bonds. And the third is currency. Global currencies offer opportunities for higher expected returns and reduced volatility. Now, holding securities across many market segments can also help manage overall risk. Diversifying just within your home market may not be enough. Global diversification can broaden your investable universe and is a much more sensible place to start. For example, a single market such as the UK has 322 publicly investable companies, but a global example such as the MSCI ACWI has 47 countries and 8,977 companies. And just before we continue, if you'd like to go deeper on all of this, we've put together a full guide that breaks down the exact steps for pursuing a better investment experience. You can download it for free using the link in the description. You never know which market segments will outperform from year to year, but by holding a globally diversified portfolio, you're always well positioned to seek out returns wherever they occur. Investors often tell me they aren't timing when they make market predictions or they feel a certain way, but the fact that they even mention it means they probably are. Many people really struggle to separate their emotions from investing. Markets go up and down all of the time, but reacting to current market conditions may lead to poor investment decisions. No one knows what's going to happen in the future, and it's entirely human to react in the opposite way than we often should. Daily market news and commentary can challenge your investment discipline. Some messages are there to stir anxiety about the future, whilst others tempt you to chase the latest investment fad. When headlines unsettle you, consider the source and maintain a very long-term perspective. Do you know what investing for the long run but listening to the news every day is actually like? It's a little bit like a man walking up a big hill with a yo-yo, but keeping his eyes fixated upon the yo-yo instead of the hill. A good financial life manager, who will always be independently certified as a fiduciary, can offer expertise and data and sage guidance to help you focus on actions that really add definable, measurable value. These perspectives can lead to a better overall investment experience. Doing things such as creating a life strategy to fit your life needs and overall risk tolerance. To structure a portfolio along the dimensions of expected future returns, to diversify globally, to manage your aggregated costs, expenses, turnover and taxes, and to stay disciplined through market dips and swings. So at the start, I promised some potentially perspective-changing wisdom. And I wanted to highlight that despite all of the above, when it comes to personal finance, what really matters isn't beating an arbitrary number or benchmark. What truly matters is actually meeting your life goals. A benchmark, of course, is just a broad measure of how any particular market or index has done. For example, the average of how all the other private wealth managers have done. And the traditional investment industry thinks that their entire purpose in life is to convince you that the best thing you could ever do is hire them to try to beat a randomly chosen benchmark. Now, if you choose the right benchmark, and it's debatable if that is even possible, but let's just focus on why this doesn't matter. Pretend, for example, that you live in some magic fantasy world where all of your dreams, according to the traditional investment industry, come true, and you actually beat the randomly chosen benchmark every single quarter for the whole of your life. Now, I hate to burst your bubble, but it's completely possible that even if you do that in that unlikely scenario, you still don't meet your financial goals, because beating a benchmark has nothing to do with meeting your personal financial goals. This has everything to do with careful, prudent financial planning. For example, let's flip that scenario on its head. You slightly underperform the randomly chosen index every quarter for the whole of your life, but because of careful financial life management, you meet every one of your specific financial life goals. You prosper across all of life's domains, you flourish and your family thrive. I'd argue that this is far more important. Now, you can have all of the money in the world, but if your investment strategy is built upon the wrong priorities, it will quietly fail you. And that's exactly why so many high net worth individuals get it so wrong. So, if you want to avoid these same mistakes, watch this video next where I break down why millionaires often suck at investing and what you should do differently.